Did you know that 78% of entrepreneurs are still actively working in their businesses well into their 60s? Not because they want to, but because they have to, because things didn't go according to plan.
Yeah, and the really shocking statistic in that is that despite building successful businesses that generate millions of dollars in revenue, most entrepreneurs actually retire with less wealth than their employees who invested consistently over time.
So today we're going to reveal why so many business owners build successful companies, but fail to build lasting personal wealth. The secret is understanding cycles.
All right, so let's dive in.
Welcome to Own the Exit, the podcast dedicated to helping entrepreneurs and high-income professionals build lasting wealth and secure their financial future. I'm your co-host, Aaron Leatherdale.
Hey, and I'm Caleb Edwards. We're excited to be tackling what we think is one of the most important topics for business owners today, and that's why business success doesn't automatically translate into personal wealth.
Yeah, Caleb and I have both been on this journey ourselves.
Absolutely. And I think the first thing is that too many business owners take traditional advice that's more about building the business than it is building what the business was created to do in the first place. And the intro scripts to this show, we talk about how every entrepreneur sets out with one goal in mind: financial freedom. They want to build a business that eventually they can pay someone else to manage so they can sit back and watch the money pile up. But most business owners actually fail in doing that. And the reason I think that's the case is they're constantly reinvesting in the business. And we understand that. Like, we're business owners, right? We understand constantly and consistently investing back into the business, investing into new hiring, investing into new systems, new products, expansion, new office, all the different kinds of things. But a lot of times we forget that the whole reason we started that business in the first place was to build personal wealth and personal financial freedom. And obviously we want to help as many people. Love the fact that we have employees that we can pay really good incomes and they can take care of and support their families. There's something that's really personally fulfilling about that, I know, for both of us. But ultimately, we're not doing business so that we can make other people wealthy. We're doing business so that we can make our families wealthy. And I don't think it's wrong to admit that and to say that. Now, the principle for doing that I personally follow, and I know, Aaron, as we've been partners in business for a while now, that we collectively follow is if you help enough people get what they want, then you'll have what you want. But at the end of the day, if you forget why you started your business in the first place, you end up shooting yourself and your family in the foot. And there's a shocking statistic we mentioned at the top of the show. And I want to unpack it for a second, and I want to talk about why we think that's the case. And it's this, that more business owners are retiring, selling, getting out of their business later and later in life. Not because they have to, or not because they want to, but because they have to keep working in their business. They're not actually able. 78% of entrepreneurs are working in their business well into their 60s.
Wow, yeah.
And meanwhile, the employees that they've been paying are retaring with better wealth, more financial stability than the business owner themselves have. And that's an actual statistic.
Yeah.
So why, Aaron, do you think that's the case? Is it a mindset thing? Is it a strategy thing? What's the reason why that statistic is so
both.
Alarming? Probably you both?
Yeah, mindset and strategy, I think. We talk about this all the time. But to your point of going into business to build wealth for yourself, I think it's the same reason that you are employed. If I start a business, I want to make personal wealth and income. Yeah. If somebody works for me at that business, they're doing it for themselves too, right? They want to have income. And so I think, but like you said, if you help enough people, if that employee is adding more value, then that employee, in theory, have raises, have promotions, move up, have more responsibility because they're adding value, just the same as you're doing on the business side. But I think mindset is a big part of it because we talked about ego, right? The ego is and it doesn't always be a negative type of ego. Yeah. It can just be more of a mindset of building the business around the guy that started it or the founder, where if that person, they have to work, right? Yeah. Yeah. Where, we're doing this with our construction company right now is every single process, every phone number that's in somebody's cell phone, every piece of information that's floating around, every actual physical piece of paper that's not like in a digital format that's filed somewhere, like where we all have access to, like across a shared like company folders and everything
Yeah.
is bad.
Yeah.
Because then if that person quits tomorrow or we need to add another person that supplements their role, it's just harder. So
Yeah.
I think that's, but I think that you would think that's your strategy, but it's actually goes back deeper as mindset.
Yeah.
I think it's where it starts is emotional. I think a lot of business owners are emotional because it's their baby.
Yeah.
And it's the same reason parents don't want to have a babysitter and go on date night because they're like, oh, who's going to watch my baby?
Yeah.
I got to put my baby to bed, or I've got to do it's. And with your business, it's like you can get that way when it's like, it's just a business. Who cares? Like you should be able to hand off pieces of that. But we don't, though, because it's blood, sweat, and tears to get it to where it is sometimes. So I think,
and sometimes depending on the stage of the business, like those things are necessary. It's not always feasible at different stages of the business to say, okay, it doesn't make financial or economic sense to hire someone to do all of these tasks, even though these tasks are like burning through my time. It's not always feasible, and we get that. So if you're an entrepreneur, it doesn't mean the answer is just go out and hire someone or delegate every single thing. Like you do have to make wise economic financial decisions, because a lot of what happens is the inverse of that. Is you have a business owner that, that follows the principle of just always focus so much just on continuing to expand, continuing to grow, that they're constantly trying to offload tasks to someone else and eventually hire someone else. And you end up shooting yourself in the foot because you hire too many people. Now you've got too much payroll.
Right.
Now there's more stress on you as the business owner to maintain that.
Yeah,
rather
you don't have
than
good training systems.
Exactly.
And when you offload stuff too quickly, then the quality goes down.
Yeah, because a lot of times we as business owners, we want to offload stuff, we want to delegate, but so much of what we do is housed up here. So many of this, it's like we're just keeping track of everything in the greatest computer that we have, which is our brain. The problem is that's not very efficient to passing that on to someone else. And I want to back up for a second, though, and talk about hiring, because that is something that I know our listeners, that a lot of entrepreneurs get it wrong when it comes to hiring. And I love Donald Miller, right? The story brand guy and Business Made Simple guy. I've learned a lot through his teachings, his books, things like that. And one of the things that he said in Business Made Simple that just made so much sense to me is that if everyone were walking around with a dollar amount over their head of what they're worth to a business, that number should be 5 times whatever their annual salary is. So what that means is if someone comes in and they're getting paid $100,000 a year to do a job, then that job and the work that they do, you should be able to tie to that person $500,000 of yearly revenue. They should be able to produce 5 times the yearly revenue of what they get paid. And if we think about that strictly, it's look across all revenue.
Okay.
Yeah.
Not profits.
Not profit, because
it's just growth.
Exactly. It's revenue growth. It's like actual money coming in. Their role should contribute to and be responsible for producing 5 times the amount of revenue of what they get paid. Yeah. That's his principle. And he breaks it down in the book.
Yeah, that's awesome.
And so I think when you're looking to hire someone, there should be at the very least, anecdotal case for why hiring that person and paying them $75,000 a year, $100,000 a year, whatever it is, hiring that person, there should be at least, at a bare minimum, an anecdotal case for why doing that will increase the company's revenue by at least 5 times.
Yeah. No, I was just having this conversation literally with someone 2 days ago. And I would add to that too is the value that they bring can also be related to reduction of expenses. Because I have somebody that they want more money now. And so I'm like, all right. And we came to that we came down to that conversation of what value they're adding. And we even talked about, we've got this other guy, and let's say we're paying him $60,000 and he's adding $60,000 in value. Then what is the purpose of having that person?
Yeah.
There is no purpose.
Yeah.
If you just remove them, you'll be in the same.
Exactly.
And so adding that revenue, and plus you got to manage them.
Yeah.
Because that 5X of revenue is like, there's a lot more to it on the business side that employees may not see.
There's a ton
payroll,
more
taxes, training, all the onboarding, all the management of them, the integration with the other team, how it ripples through the culture and the roles and how everything, there's tons to it, right?
Yeah.
And of course, revenue doesn't mean a lot. We know that.
Yeah.
It's not profit.
You can have $1 billion a year revenue. Like I think about Amazon when Amazon first started, Jeff Bezos was the guy who was like trumpeting that we lose so so much money every
Oh, yeah,
single
I've seen
year,
that.
and you see their stock prices continue to grow, and it's like this weird thing of people are for 10 years, I think it was, Amazon
They were
lost
just
money every
monsters
single
with
year.
reinvesting it all.
They just lost money like crazy, and now Amazon's like insanely profitable, right?
Yeah.
But it was
Reinvesting.
and that kind of does that transitions to really seamlessly to kind of the next thing that I wanted us to talk about, and that's what we mentioned at the top of the episode, and that's understanding market cycles. And when we say market cycles, people typically think about that in the context of investing. We're in a bull market, we're in a bear market. There's different, the debt cycle. A really good video to watch on that, by the way, is, I don't know, it's about 10 or 12 years old, but it's Ray Dalio's video on how the economic machine works. And he talks about the debt cycle. It's like a 30-minute video, but it's super informative. Anybody out there who hasn't watched that, just go on YouTube and look up How the Economic Machine Works by Ray Dalio. It's super insightful. But it talks about cycles, and we normally talk about market cycles in the context of investing, and our company happens to be a company that does investing, right? Asset investing. But I think we have to understand that market cycles are the same as business cycles, right? Your business is going to fluctuate in cycles. You're going to have periods of expansion and growth where new revenues coming in, more profits being achieved. You're going to have growth phases, expansion, and then you're going to have those peak or floor phases, right? Where you get to a point where it's okay, now things are stable and they're not really growing, but we're not really losing. Like we're just maintaining. Don't despise those seasons. Recognize them and know that if you are at a stable place in your business, just at right on the tail end of kind of a lot of growth, and now you've been stable for 3, 6, 8, 12, 18 months, whatever the amount of time is, odds are, just statistically and scientifically, odds are the next phase of your business is you're probably going to go into a contraction phase. And you maybe will start to dip down a little bit. Revenue will slow down. Your expenses will grow. You'll hire new people because you're stable. You'll feel good about it. It's just human psychology. And then the next thing that happens is you lose a big client. And then things begin to take a downward trajectory. And I think the key is not overreacting in any of those moments of the business cycle or the market cycle. Same mindset as a savvy, sophisticated investor would have is the same mindset a business owner should have when looking at cycles. Because what we do is when we're in a growth cycle, we tend to zoom in on the chart. If you think of like a stock chart, right?
Yeah.
It's full of ups and downs, but you're looking for opportunities that the general trajectory is up and to the right.
Longer
It's
term.
kind of the idea. But if you zoom in real close, you can be like, man, the only place there is to go is up. Everything's just going up
Or down.
or the only place we're heading is down and everything is bad and everything sucks. And you can overreact. You can fire people. You can make decisions because you're zoomed in too close in the expanse of time, and understanding that expansion, peak, contraction, floor, those are all normal parts of business. Not overreacting in any of those. Just because you're in a growth phase doesn't mean you need to go hire 10 new employees. Right? Because you've got all this new money and you can afford it. It's like, oh, we could just continue expanding and growing. Just because you're stable doesn't mean that you shouldn't be thinking about people that maybe need to be let go. We got stable income, profit's good. They're not really doing a good job in adding value, but they're not really doing a good job. They're not really showing up for work on time. They're not really I want to be a good guy and things are stable and all that kind of stuff. It's like, no, like sometimes you have to make hard decisions when things are stable to keep the contraction from being
and recognizing what phase you're in.
Yeah.
I think that's the biggest mistake that investors make.
Yeah.
And I'm thinking in the real estate industry as well. Real estate investing was always just getting caught, like they say, the high tide, all the boats rise, right?
Yeah. Yeah.
Even the bad deals rise, even the mismanaged ones, even the ones that were bought at a bad basis. Like we saw through the interest rate slashing on everything. But
and you're talking about just so everyone's clear, you're talking about post-COVID, interest rates hit a bottom.
Yeah.
Transaction volume went through the roof and people were massively overpaying.
Yeah. So that, everything looks great.
Yeah.
Everything's financeable. And then when the interest rates went back up, then that obviously caused a lot of deals the tide goes out and you can see who's naked or not.
Yeah, exactly.
But you want to try to see those. You want to try to see those cycles, or you want to know where you are, and it's difficult. And there's a lot of no one has a crystal ball, but I think trying to understand where you are in the cycle so that you can hedge yourself against that.
Yeah. So let's get real tactical and talk about, number one, indicators that entrepreneurs should be paying attention to in their business that will help them understand maybe what phase of the cycle that they're in. So let's take the expansion and growth phase. What are some kind of key indicators that you would point to that say, hey, our business is growing? Obviously, I would think the first is revenues increasing, profits increasing. But what are some other indicators that your business might be in that kind of expansion part of the cycle?
Yeah. When it comes to business, I think there are ways, though, of adapting so that you're always growing and not like you have control over, you don't have control over external market factors, but you do have control over pivoting your business to adapt. And so I think there are ways to mitigate the contraction that you mentioned. You don't have that if you're just in an investment and you're along for the ride in the market. It's whatever the market gives you. You don't have that control like you do in business, though.
Yeah.
Where I think you can introduce new products, you could ease the gas on ones that are not working in that cycle.
Yeah.
And so I think for what I've seen is you'll have a growth phase, and then you'll have a phase where it's just like a static, where sometimes it's intentional, where you just let off. You're like, I don't want any more business. I have to work on management.
Yep. Yeah.
Processes. We went to a new level. Say you're making $1 million a year in revenue. Now you're making $5 million. You got to grow the inside of your company to handle that, to take care of. So there's just not all the overwhelm and everything that usually happens when you grow fast. But then I don't call it plateauing. I call it intentional flat line.
Yeah.
So that you can
stabilizing.
That's what we did in 2023.
I think of it
22. We're just 22, beginning of 22. All the whole 9 months we didn't buy any deals. I think we bought no deals for 11 months, and we just part of it was market. But then I was like, hey, let's use this opportunity, because that was when the interest rates rose and the way we were doing things in our real estate business wasn't working anymore, and so
we had to recognize that the market had shifted. Therefore, our business had shifted.
So then we just worked on management. Worked on, hey, let's use this opportunity to not waste it, to have some more time to training, stuff like that.
Yeah.
But I mean, it's as far as your business going down, I think that's something that you got to always be guarding against, because I do think you have control in a lot of ways by thinking ahead, to see things like that coming and diversifying and trying to and having cash.
Exactly. And that was what I was gonna point out in terms of tactical for business owners. When you're in a tailwind in your business, maybe that's matched with a market tailwind, or maybe that's asymmetric to the market, and your business is just has its own little tailwind, is its own lane, and it's growing despite what the market's doing. We see that happen all the time, right? Businesses that thrive when the overall economy is not doing so hot.
Yeah.
But regardless of where it is, I think about my father-in-law, for example, and he learned his lesson the hard way. Pre-2008, he's a custom home builder, right? Had a company with a business partner at the time where they were building custom homes and doing amazingly well, plenty of work, multiple crews going, building these amazing, beautiful houses, people's dream homes. He's a tremendous craftsman, best carpenter I've ever met.
Nice.
He's unbelievably skilled. But his partner was more on the business side and more on the sales side and more, I would say, opportunistic would be the right word. Not a bad person, didn't have the wrong mindset, but just more always opportunistic. And they were in a significant growth phase of their company. They were seeing revenues increase. They were getting more jobs. They were building more houses. Things were going really well pre-2008. And so instead of just continuing to work what was working and stock up cash reserves, they were taking all of their cash and dumping it into building all of these speculative homes. And so they had 5 or 6 spec homes that were going all at the same time. about the time the '08 market crash hit. I think they'd sold off a couple of them before that. They had 3 or 4 of these really nice speculative homes that were built. And they couldn't offload them. And they didn't have any cash reserves.
Yeah.
Because they dumped all their cash reserves into growth.
Yeah.
And so I think the tactical lesson there, and I would contrast that with one of their subcontractors, a grading company that did all of their dirt work for all of their projects. They took the opposite approach. That regardless of if things continue to expand, we want to stock cash reserves because we want to be able to keep our employees working if things were to slow down. We want to keep some financial stability in the company. We want to keep ourselves. We don't want to lose this company because of market cycles that are inevitable. And when 2008 hit, it was 9 months before my father-in-law's company caved and was gone. Everything he'd built was gone. And this other company, this grading company, they obviously struggled too because everyone struggled, but they had built up cash reserves. They didn't just reinvest everything.
It can be discipline.
Yeah.
When you're entrepreneurial.
Yeah.
Because that's no fun.
Yeah.
Just sitting on a bunch of cash.
Exactly. It seems irresponsible. We could be expanding and growing because things are going good, but then the mindset is like things aren't always going to be going that good.
Yeah.
And so it's understanding like when you're in that expansion cycle, part of the cycle in your business, stocking up some cash reserves, at some point it's not going to be this way.
It's just like you do for personal.
Exactly.
Yeah.
Saving some money, having some money in savings, having some cash reserve. It's the hardest thing for investors to get is building your cash balance sheet because we're also growth minded.
Yeah.
But if we can get that discipline down, then we can navigate through the ups and downs a lot less stress.
Yeah.
If my father-in-law had $1 million in cash reserves, maybe that's too much, $500,000 in cash reserves, was instead of having all this money out in these speculative homes, trying to just go out and figure out ways to get more profit.
Go through a couple of years.
Probably could have kept his guys working, probably could have kept the business going a little. Maybe he would have needed to lay some people off and that kind of stuff, but the business wouldn't have caved and went away. And then he basically a few years later had to start from scratch and build it back up again. And he's been able to do that. Yeah. And I'm proud of him for that. But he learned his lesson the hard way.
Yeah.
And now he stocks more cash into his company. Yeah. Because he knows it could happen again.
Just to be stronger. Yeah. Yeah, I know. I think there's some things we do like on just back to real estate again. We'll do like a 1.5 basically multiple of, let's say your mortgage is $50,000 monthly. Your expenses are $50,000 monthly. It's 100. We'll have 150 on a cash flow positive property. So if it's cash flowing and that's separate from your reserves for your renovation piece or whatever, just your annual, you're funding for your CapEx and stuff. So that's and every business is different. We'll have a break even occupancy metric. You know, how many units, let's say you got 100 units. If we got 70 rented, we'll break even. So that's like, all right, cool. So I think you need to do that with your business. I like 6 to 9 months of, that's 3/4 of when we build out our cash flow forecast for the year. You know, it's not that way when you have a new business a lot of times, but I think it's a good practice to get there. And the more the company grows is actually more important. Yeah. Because then there's more overhead. And when you're first starting a business, the overhead's low a lot of times. You need to do it yourself or whatever. But then as it grows, to be able to ride through the 6 to 9 months, 12
the peaks,
months.
the contractions, all that stuff. Yeah, I think that, like you said, the 6 to 9 months cash reserves that's a really good principle for stabilized businesses. Yeah. What about businesses that they're burning more money than they're making, like they're in a growth or startup phase, or they're in a kind of, so there's like startup phase where you're burning more money, and then there's strategic times where you want to spend more money to expand and grow intentionally.
I think you can still have the reserves though.
I think it's even more important to have stronger reserves during that time because you're taking on more risk. You're intentionally taking on more risk, choosing strategically to try to expand and grow. Yeah. I think it's important in those moments to actually have stronger cash reserves, maybe have 12 to 18 months of working capital reserves, nice. Ideally. Yeah. And sometimes it's not achievable, but it's just having the mindset of understanding that, like, when people say cash is king, it's actually true. If you have enough cash, you can get through any cycle. Yeah. If you have enough cash, you can get through any cycle. That doesn't mean hoard all your cash, reinvest, but the goal of reinvesting is so that you can get more cash. Yeah.
For sure.
Yeah.
Good stuff. So yeah, cash is king. I used to think equity was king.
Yeah, absolutely.
I was all about building up wealth and future and getting these rental properties and getting these businesses for future. And that's awesome, right?
Yeah.
But it doesn't help the day to day.
Yeah.
So you got to have that.
I think the third big part of this conversation too is a principle where we're taking the concepts and the ideas around investing and applying them to business. And that is thinking more about your business as an investment, but also thinking about your whole financial situation as an entrepreneur the way an investor thinks about it. One of the number one rules of investing and wealth building is diversification. If yes, the best way to build significant wealth in this country, at least, is to build an amazing business. That is the number one way to create real wealth.
Yeah.
But the reality is that very few people actually are able to start and go all the way through to the end and achieve that actual goal for themselves.
Yeah.
And that's the whole problem that we're pointing out in this. And so in order to hedge yourself in the journey, some of the most successful entrepreneurs that I know, they do reinvest into their business, but they also reinvest into other things that they understand that don't require their hands on that don't require their active involvement. And this is such an important part of my journey. I had the wake-up call when I've shared on the episode before when my 9-month-old son had a very serious, life-threatening medical event that spun me out. Everything I was building up until that point was my active hands on the wheel, even my investments, right? It was active swing trading. It was active real estate. It was active everything. It was, if I didn't show up, put my hands at the wheel, put my hands at the keyboard, all that kind of stuff to work the plan, then it wasn't going to work for itself.
Yeah.
So one of the big
job.
It's called a job. It's not an investment strategy. Like I thought, oh, I'm investing in in the markets. I'm doing all this stuff. But the truth is I was just active going out and earning money.
Yeah.
Using these different instruments of investment to do. But my whole mindset shifted whenever all of that happened. And in 4.5 months, I lost 40% of my net worth because I was overexposed in the stock market in higher risk positions that I wasn't actively monitoring, hadn't set the correct stop losses on and stuff like that because my mind just wasn't in it. My head just could not be in it at that time. And so because of that, I lost 40% of my net worth in about 4.5 months. And that was a wake-up call for me to realize you're an entrepreneur, Caleb. You can go out and always figure out ways to make money. But the big wake-up call is when I saw my son laying on that hospital bed. And obviously I was insanely heartbroken that he was going through what he was going through and that our family was going through it. But the thought that I had that made me realize I was doing things the wrong way was, what if that was me?
Yeah. Wow.
What if that was me that was on that hospital bed? What would my family be then? Would my family be okay? Is my situation secure? And the arrogance that we as entrepreneurs have, that we're unstoppable supermen, that will never have that kind of stuff happen.
Yeah.
Well, when it happens, you realize just how fragile your situation is. And that's what I realized. And so I think it's important, and closing out the episode here, I'd love to talk about this for a minute or two, is diversifying, taking cash flow from your business and reinvesting it into other investments. We like alternative investments. We like real estate, multifamily. We like oil and gas stuff. We like short-term hard money debt lending, that kind of stuff. It's a good diversification strategy for us where we're getting stability and upside of real estate. We're getting really strong cash flow from the oil and gas stuff.
Right.
And we're getting stable, lower cash flow income type play, but a liquidity with the short-term private hard money stuff, where our money's not tied up for years and years. Yeah, we can get
different options,
get that money back, and that's what I know. We personally, you and I together as business owners, that's what kind of we're focused on, is that kind of alternative investment trinity, and we've talked about that in previous episodes. But I'd love to hear from you, Aaron. Why do you think it's important for investors to invest outside of the thing that they're building and in other things?
Yeah, lots of reasons. The thing you're building is where your area of expertise is, but that's very narrow relative to everything that's out there. So you want to sync up with people that have areas of expertise in other places, businesses, markets, investments, things like that, where you can leverage them, just like you do in your business. Unless you're a solopreneur, I'm sure you have a few employees, or why do you have them? Same purpose, right? Yeah. To leverage their talents, upload things to them and get a return from them.
Yeah.
And I think how I like to do it is, let's say I need $100,000 a year to live. I
Yeah.
want to make $100,000 through active income, but I also want to make $100,000 through passive income, because at any point I can stop doing the active and the passive is enough to cover the 100.
Yeah.
And that's just how I do.
Just think about it.
I'm
Yeah.
not necessarily trying to replace my active income, because my active income will keep growing as I'm active.
Yeah.
And my passive income in theory will keep growing with it. But either of those amounts is more than I would need to just live on. So then that way,
And that's whatever that number is. I know you're using 100,000.
Just making up a number because
half a million, it could be a million, it could be 50,000. Like, it doesn't matter.
Yeah.
It's like wherever you are, whatever your standard of
that
living
number
is.
seems to go up too. Over
They go, yeah,
time.
no, it always does for everyone. But yeah.
But yeah, so to answer your question, I want, if I'm laying in a hospital bed one day and I can't do the active, I want to have the passive that replaces it. But that doesn't mean, me personally, I'm not trying to work myself out of the active.
Yeah.
I love active income.
Yeah.
But I don't want it to be, but I don't think it's smart for that to be the only type of income that I have.
Not only is it not smart, it's irresponsible, in my opinion. It's irresponsible to your family because you're already taking a big risk by being an entrepreneur.
Yeah.
Building a business, you're already choosing the less typical, less, quote, stable path.
Sure.
And I think for the right person, it's 100% the right decision. If that is what you are supposed to do and that is the way you are wired, then it's absolutely what you are supposed to do. But it's also understanding that you are putting your situation, family, at a lot more risk.
Yeah.
So you need to make some wise decisions to make sure that you are covering your bases in case you're not able to always perform actively at the level that you currently are. Because the truth is, my family, for me, and I know this is true for you, like, they are the most important thing to me. The only reason I go to work in our businesses every day is to provide for them. I'm simple. I'm easy. Like, I don't need much. It's really for them. And so what am I building to ensure that they have that with or without my active involvement? And that's really the whole heart of why we started this entire show, is to help entrepreneurs wake up to the reality that you are not Superman, and most entrepreneurs fail to build businesses and build wealth that actually serves them, and they just enslave themselves.
Yeah.
And the whole message of Own the Exit is we want to help you at least at a mindset level, but also at a tactics and strategies level, to get this thing called wealth building holistically, not just learn how to build. Tons of podcasts out that can tell you how to build a great business, that can tell you how to build a business that makes a lot of, produces a lot of revenue and puts a lot of money in your pocket. But there aren't a lot of podcasts or business conversations out there that are happening about how to leverage your entrepreneurial gifting to actually truly build lasting wealth that outlives you.
Yeah.
That outlives you, to build generational wealth. And you're not going to build generational wealth by just increasing active income that you get from your business. You have to diversify outside of that. We like alternatives because they're hard assets, they're real, they're not subject to the typical kind of volatility of public markets where someone can put out a tweet and you can lose 40% of its value overnight or whatever it is. They're actually tied, and I'm closing out, I've said this a bunch of times, can't hit it enough, is that most entrepreneurs and investors have this mindset, and it gets said, don't invest in anything that you don't understand. And I agree with that to a certain degree.
If you're the one doing it.
If you're the one doing it, even if you're investing in it, you need to understand it, but you don't need to. It's like some people, they invest in Tesla stock, for example. How far are you going to take it in having to understand that? It's what I understand in order to give me confidence to invest in Tesla stock is they're really good at making electric cars, marketing them and selling them.
Yeah.
And solar panels and all the other products that they sell.
Yeah.
That's what I need to understand. I don't need to understand how a Tesla engine is built or motor is built. I don't need to understand what components are required to go into the battery. I need to understand all of the intricate engineering designs.
Right.
And that's, I think, the trap that so many entrepreneurs fall into is they're running their business and they know all the dirty details of their business. And so they think if I'm going to invest in something else, I have to know all the dirty details before I can feel confident to invest. That is not the case. You're shooting yourself in the foot if you have that mindset, because no one is ever going to achieve that. Do you actually think Warren Buffett, who's one of the largest shareholders in Coca-Cola, actually could go into his kitchen and make Coca-Cola with raw materials and ingredients? No, he has no idea the recipe for how to make Coca-Cola. He just understands the basic business model. He drinks it. Exactly. He's, oh, this is good. People will like it. They'll probably buy more of it. And Coca-Cola is really good at marketing. It's that simple. And so I've said this before, but I want to give the 3 big questions that you need to understand before you invest in something. Number 1 is, what is the revenue source and how can it be increased? So with apartment buildings, rent and other income, coin laundries, maybe a shop where people can buy basic stuff in the common areas or whatever, vending machine, all the different ways, paid parking, paid cover parking, whatever it is, different revenue sources, primarily rental income.
Late fees.
Yeah. You don't like those, but you like those. You know
you're going to get them though.
I love it when people are exactly 10 days late because they actually paid their rent, but they pay the late fee. But the understanding the revenue, and then how can that revenue be increased? Okay, we can improve these units and make them more desirable where people are willing to pay a little bit more there monthly to live there. That's the apartment example, right? Revenue, how do you increase it? Expenses. What are the expenses and how do you decrease them? How can you do it more efficiently? How can you do it with less outlay of expense? And then the third question to understand, to know if something is investable and you can understand it, is who are the people that are responsible for executing plans 1 and 2? Because if you believe that those people know what they're doing and they have a track record of doing it, then you can feel confident. You don't have to, that's what it means to understand something, the degree that you can invest in it, not I know, exactly what kind of carpet's going in the unit. I know exactly, what is it, stainless steel appliances or is it not? Is it all this? It's like none of that stuff matters. You're using brain power for something that is not important.
Because you likely have an area of strength in. So my big takeaway on this is there's really 3 steps to building wealth. First one is put all of your energy into increasing your active income. Get that as high as you possibly can. Number 2, build up your cash reserves to protect that. Once step 1 and 2 are done, then step 3 is you begin shaving off and start diversifying into some of these alternative investments. And don't mix up the order.
Exactly.
Because if you do it too soon, you run out of cash and you got this thing and maybe it doubles, but you don't have any monthly. I think you got to do it in that order.
Absolutely. I couldn't agree more. That's all we've got for On the Exit today. Thanks, guys.